Welcome to Remarkable Retail Podcast, Season 10, Episode 19. I'm Michael LeBlanc.
And I'm Steve Dennis.
Our very special guest in this episode recorded live in person at the Shop Talk event in Las Vegas is Stephen Yalof, Director, President, and Chief Executive Officer, Tanger, which, like a few other things, I've been mispronouncing for most of my adult life, by the way. Stephen has been CEO since January 2021. Tanger has a portfolio of 37 outlet centers, 1 adjacent managed center, 3 open-air lifestyle centers, including 16 million square feet, well-positioned across tourist destinations, and vibrant markets in 21 U.S. states and Canada. Before joining Tanger, Stephen served as CEO of Simon. He's been on the other side. He's SVP of Real Estate Ralph Lauren. He was with The Gap. Stephen, what a great conversation. Forgot at some point that we had mics in front of us, actually, as we mined into Stephen's rich insights and background on both sides of the retail real estate negotiating and operating tables, right?
Yeah, I thought it was a really fascinating look at both the kind of broader world of value retail, not just the kind of traditional outlet stores, factory outlets per se, but also kind of the shifting nature of these centers and what's going on in retail real estate more broadly. So I think people will find it quite interesting. I also thought, since we, as you mentioned, recorded this back in Shop Talk, so a little while ago now, a couple months, I guess, a little more current events from Tanger. They reported their quarterly earnings a few weeks back, and they're pretty good. Mm-hmm. Their occupancy is at nearly 96%, and their sales per square foot were up nicely, nicely profitable as well. And then I thought one of the more interesting things, which is also news a couple weeks old at this point, but people may not have seen it, is they announced they're going to start their back-to-school campaigns almost 2 months early because of all the craziness going on in the world. So I think we're seeing quite a lot of companies kind of moving around their promotional schedule. Prime Days, I think, have moved as well. So anyway, it's just kind of, we'll get into that a little bit more in the weeks ahead, but they decided to accelerate back to school.
Speaking of which, let's dive right into the news of the week, and let's start with tariff turmoil, and a little less turmoily, so to speak, this week. Take us through what's going on and the highs and lows of it all.
Yeah, pretty quickly here. There's been so much news on the U.S.-China stand down, I guess, or partial stand down, you could call it. So try to make some maybe different points that people have heard, but yes, as people would know by now, the escalation got de-escalated, or at least largely, and the market loved it and seems to continue to love it since the announcement, which I find a bit unusual. Not that it isn't better. We stepped away from the precipice and what was essentially an embargo of products coming from China to the U.S. at least. Many of our listeners in other markets will know that they've been flooding some other markets with all the excess product. But it does unfreeze the embargo, a little less pressure on pricing for a period of time anyway. We'll see how this all settles out. And I think importantly, for at least U.S. retailers, there is now a 90-day window, presumably, could be extended for folks to try to get product in. As we've talked about a bunch of times, there was this pull forward, then there was basically a shutdown. So that creates some interesting opportunity. I did talk to a couple people that are more knowledgeable about this than I am, saying, well, it's good, could help the fall season and the holidays considerably having this window, but there are still 30% tariffs. Actually, if you take the effective rate, apparently it's closer to 39. So that is much higher than there were previously. So that's not nothing. And because of where ships are positioned and ramping up of production and all that kind of stuff, it's not really 90 days to get this product through, probably closer to 60. And both folks that I talked to said, this will be very helpful, but there's no way we're kind of back to normal for the next several months. So
I guess it's all relative, right? I mean, it's not 145, but it's huge compared to where we were months or a year ago. Like, it's a lot of...
Absolutely.
We're going to hear more about that later in the news, right?
Absolutely. Yeah. And I think, as we've talked about, the impact on smaller businesses that don't have the capital structure, the flexibility, the storage space, that's a whole different thing. So, yeah, we'll touch on that a little bit. The other thing, partially relative to the market is it seems like the market keeps forgetting that Trump is Trump. And I saw one account that there have been 50 changes so far in announced tariff policy since this all started. Mm-hmm. It's still not clear what the goals are. I'll make my one very political comment, which is if you look at the actions that Trump has taken rather than what he says, he seems very focused on what's good for him and his family, not necessarily the country and the world at large. And there's just a bunch of crazy things that come out. Many folks have probably been following his trip to the Middle East. One of the big announcements there was that Qatar might invest $1 trillion in the United States, which sounds wonderful. There's no way that's going to happen. The GDP of Qatar is $350 million. So the idea that during the Trump term, they're going to invest as much as their entire GDP seems pretty unlikely. So anyway, we shall see. A lot to happen, obviously. But as we kind of
guess you guys get an airplane out of it somehow anyway.
Absolutely. By the way, personally, I'm willing to do a lot for a lot less. So
we would keynote for less than a luxury Boeing airplane.
And less of a security risk, I'm going to say as well. But anyway, we'll let other podcasts go deep on that particular topic. But, just kind of what this means going forward, still, people keep talking about this as kind of a vibe session because the soft data is pretty concerning. Mm-hmm. We'll talk a little bit about Walmart's earnings in a second. But, the hard data still looks pretty good. Inflation,
food inflation was down, actually, not up, which was jobs, a surprise to many.
Unemployment staying pretty constant. Retail sales kind of hanging in there. So we shall see. But, we do see lots and lots of glimmers of concerning news. One thing that came out last week was that the Small Business Optimism Index fell 1.6 points in April. That's the second straight month it's been below its 51-year average. And again, that I think gets to how some of the economic policy is hitting smaller businesses disproportionately, or at least they're not able to respond as well as some other companies. So one of the things I would say, and I'm sure people have heard me say this before, if they've read my book, they know that I quote Hemingway about this one scene where a character asks the other, how did you go bankrupt? And he responds 2 ways, gradually, then suddenly. Yeah. And I think what we're going to see over the next several weeks are prices starting to tick up, and then other signs of fraying, which then could really start to accumulate as we get into the summer. So I would say some of the things to watch beyond the obvious are what's happening with longer-term interest rates. Those continue to stay high. And with, not to get too in the weeds here, but because of what's going on with the U.S. budget discussions, which look to be raising the debt ceiling considerably. And of course, we have to finance that here in the U.S. That will tend to keep interest rates high if that doesn't get addressed in some ways. But also watch things like credit card delinquencies, late payment on rental apartments, job numbers, all that kind of stuff. Perhaps we'll see more resilience there, but most people are thinking we will probably not.
When I'm asked about the impact on small versus large retailers, I often relate the story about I don't know if you remember, during COVID, when you couldn't get a box across the water, Home Depot bought a boat. And, so these big retailers, God bless them, they've just got resources that are unimaginable for the small indies who really get punished by this stuff. So I want to just keep bringing that up because it all seems at the high level things are okay, but there's people who are going to lose their houses over this, and I just want to call that out.
Well, yeah, I would add two other things. One is just in general, you've got to finance this inventory, right?
Yeah,
and so
right.
Some of that has to do with your payment terms, or how you get paid as a small business. You may have to wait quite a long time, whereas some other folks get paid more quickly. Your cost of borrowing, if you're a small business, your cost of borrowing is definitely a lot higher than Home Depot or Walmart.
Yep.
And if you've got to go out and rent additional warehouse space, use one of these bonded warehouses to try to play around and hope the tariff rates come down. I mean, it's just a whole different animal.
Yeah, it's a lot.
Unfortunately.
Let's move on to earnings, and let's talk about the biggest of the big, Walmart, who put out their earnings and a very interesting warning.
Yeah, a couple things here. So we are, as we've mentioned, about to get into the heart of earnings season. So many big retailers will be reporting over the next couple of weeks. Walmart was up first in this batch, and they beat on profits slightly. Their sales came in a little bit light, but comp store sales were over 4%. So that's higher than average for sure. So they keep rolling along. Their ad business is doing great. Lots of very positive things. But they did withdraw their Q2 guidance for all the reasons we've been talking about. And one of the things that's gotten a little bit of press are conversations with both their CEO, Doug McMillon, and their CFO about how they are starting to raise prices. Their intention is to try to absorb what they can. But one of the things that the CFO said that I thought was pretty interesting, and maybe just because it lines up with the way I think about it, is they're paying a lot of attention to elasticity of demand. And one of the things he said is, there's some items that are so expensive and the tariff impact would be so significant that we know the volume would drop. So essentially he's saying we'd rather sell something at a lot less margin and actually sell it than forego those gross profit dollars, is kind of the way I'm thinking about it. And he even said that there may be opportunities to take some prices up on non-tariff goods to allow them to pull back
for the blend
on tariffs. So, they're a very sophisticated company. They've got sophisticated software. They're testing stuff all the time. But the net of it is prices are going up. They're going to try to be very strategic and try to grow market share as opposed to maximize their gross margin or just kind of hit their gross margin rate markup percentages kind of with a formula. So anyway, we already talked about, I think, their advantages. They've got obviously the scale and scope, leverage on some of their suppliers, that this is likely to not hurt them too badly. And as I said, I think they're going really after market share and preserving their long-term positioning and their reputation for low prices.
Let's talk about a favorite brand of yours, Mine Teresa. Okay, not bad. Sales up.
Yeah, we had a few other earnings that came in. The real star of the batch was On Running. They were up 40% in their sales, and they also raised their guidance, and their profitability was good.
Yep.
My Teresa, not quite as robust, but sales still up 4%, which compared to some of the other luxury players, which we'll mention in a second, was quite a bit better. But they also really warned about tariff impact and even the high-end consumer pulling back. But then we had a few others that were really, really ugly. American Eagle's sales were down quite a lot. They had to write down a bunch of inventory, and they also withdrew their guidance and didn't paint a very rosy picture for the future. Penney, which is part of Catalyst Brands now, and they don't report because they're not in the same way because they're not a publicly traded company, and they also release their earnings quite late. So this is the quarter ending in January, and they don't provide as much detail, but the net of it was their sales were down 9%, which obviously objectively is a pretty bad number, but definitely worse than I think we're going to see from Kohl's and Macy's in a couple of weeks, though I expect both of those companies will be negative. And they were making a little bit of money, but they swung to a pretty significant loss. So things not so great up the road from me in good old Plano, Texas. And then going back to the luxury space, Burberry, which is going through a turnaround under newish CEO Josh Schulman. Fun fact, we tried really hard to recruit Josh to join the Neiman Marcus group when I was there. He was running Jimmy Choo, I think, at the time. He subsequently did join Neiman Marcus a few years after I left, was at My Teresa, Capri Holdings, Tapestry, now leading the turnaround at Burberry. But anyway, things aren't yet gaining traction there. Their sales were down, or their comps were down, I should say, 12%, big drop in profitability. And they announced they are eliminating 1,700 jobs, which is really quite a lot.
That's big for a company that size. Yeah. That's a major cut.
So, which Wall Street loves.
Yeah, but sure.
Where bad news is good news, depending upon where you sit, I guess.
Well, it's a good quick rundown. Shout out to our friends at On Running, and we got another couple of big retailers, as you said, coming up. We've got this refinancing a go-go stuff going on with Kohl's and Saks Global. Saks announcing today, we're recording this on Thursday, that they're slashing vendors and doing, they got a big thing coming up. Talk about both of those.
We've talked about both of these before, so I'll make it quick. But, we mentioned, I think, a week or two ago that Kohl's, they've got their CEO issues, some board fighting, like a bunch of stuff going on there. They need to refinance a payment that they have coming up in July. So they basically explained what they were trying to do, hoping to do. And, it's a tough market to raise financing in general, but obviously given their trends there and the fact that they don't have a permanent CEO. So good luck and Godspeed. I suspect their earnings, they pretty much told Wall Street their sales are going to be down 4 to 5%. We'll see how profitability shakes out. And then Saks, it seems like different, another day, a different story. William Cohen at Puck is doing a lot of reporting on the gyrations there. They have retained 2 firms to help them raise some more money, but both those firms have a lot of experience in restructuring and bankruptcy. So that is getting the rumor mill going that they may need to reorganize under bankruptcy. Those of you that follow me on LinkedIn know that I've posted a bit about what's going on with the debt they already issued. It is trading way down. If you bought that debt at the issue, you would have lost quite a bit of money. It's very, very much underwater. The effective interest rates are going up as close, pretty close to 30%. So let's just say there's a lot of nervousness. So I suspect we will hear some news there quite quickly.
Well, last story, good news story, I think. We'll see. Yeah. And shout out to our friend. She's been on the podcast before, reporter Lauren Thomas. She was with CNBC, now as breaking news at the Wall Street Journal, covering the M&A beat. And she broke some news yesterday with Dick's Sporting Goods. Talk about it.
Yeah, shout out to Lauren. She's become a real scoop machine. I can't, somebody, she's a great reporter in general, but she's definitely gotten wind of quite a few really interesting deals. And so, Dick's Sporting Goods is acquiring Foot Locker for a couple of $2 billion. I did not see this one coming. Foot Locker, as folks would know, and we've talked about, is also undergoing a turnaround strategy. And they are, they've made some progress on that. We've seen some of their new lace-up stores, which look pretty good, but the numbers have not been great overall so far. So I guess there was a little speculation that they might be a good takeover target. I just sort of assumed in this market with all the gyrations, we talked about Skechers last week, just seems like a really tough time to acquire a footwear company. But nonetheless, I guess Dick's likes the price they got. And I think this is interesting for at least a couple reasons. One, for Dick's, this will get them into international markets because Foot Locker has quite a lot of stores outside the United States, whereas Dick's is basically a U.S.-only company. So that's kind of interesting. And the second thing is Nike has 3 big customers globally: Dick's Sporting Goods, Foot Locker, and JD Sports. So
now they have 2. And now they have 2.
So what this will mean for Nike, what this will mean for the whole kind of athletic footwear ecosystem, we shall see. But anyway, the indication from Dick's is that they will run Foot Locker and Dick's independently. And I don't know what this will mean for Mary Dillon, who's the CEO of Foot Locker, previously really responsible for a lot of the growth at Ulta Beauty.
Yep.
So, interesting time. So, I really thought the deal market was basically going to be ground to a halt, even though I predicted before the year started that we'd see a lot of deals. That all changed with Liberation Day. But nevertheless, some people are moving ahead.
Well, they might be operating Dick's and Foot Locker separately, but I'm pretty sure they'll be negotiating with one very much bigger pencil. So
yes,
good luck to Nike and all the brands that they do business with. Let's get to our fantastic interview with Stephen Yalof from Tanger. Stephen, welcome to the Remarkable Retail Podcast. How are you this morning?
Great, thanks. Thanks for having me on.
We're here live together in Las Vegas in a fairly spacious boardroom, so befitting of your stature. You never know where you're going to find yourself sometimes in these rooms. Thanks for joining us. When did you get into town?
Just yesterday. So we had a full day yesterday, and have some meetings this afternoon, and then out you go. There we go.
Fantastic. So we know a little bit about you, but introduce yourself to our listeners. Who are you? And we were talking off mic. You got a great background in retail. We were just chopping around early days, and when you were at the Gap and Canada and Eaton's. But tell us a bit of your background and what you do for a living.
Sure. Well, been in the retail real estate business my entire career. Started out leasing shopping centers for a company called New Plan Realty Trust. Back in the early 90s, that's when sort of outlets first became a thing, and New Plan had 4 of them, soon 5. We built 1. From there, I went to the Gap and spent 5 years at the Gap. My primary responsibility at Gap was finding store locations for their New York City, 5 boroughs in New York City, and ultimately, when Old Navy was making a play for Canada, I headed up a team of people, and we went after Old Navy Canada.
Fantastic.
Left the Gap and went to Ralph Lauren. So I had a 14...
Any brands we would have heard of?
Had a 14-year career at Ralph Lauren. Was hired at Ralph Lauren because of my international experience. Just coincidentally at the time, Ralph Lauren had just bought Club Monaco, which was a Canadian brand, as you're well aware. And so, I had some experience.
Joe Mimran. Yeah.
Exactly. I had some experience in the Canadian marketplace, through that Gap experience that I had. And obviously the outlet, those were the 2 big things at the time. So I was lucky to land that position and stayed there for almost 14 years where, my job went from being a domestic one to being an international one. And so Ralph Lauren at the time was primarily licensed overseas, and the leadership thought they could do a much better job owning those stores themselves. So part of that job was to evaluate all those licensed stores, figure out which ones we want to keep in South America, Europe, and Asia. So it turned out to be a really fruitful and rewarding position for me. I love the people that I got to work with, but just learning new geographies just made the job really exciting.
Yeah, fantastic.
And from there, went back to the landlord side. I had a 6-year stint with Simon, where I ran the outlet program for them. And then during COVID, I joined Tanger. Mr. Tanger had said, he wanted to move into the chairman role and out of the CEO and operator role. And so I got the phone call, and in April of 2020. 40 shopping centers, 15 million square feet, 3,000 stores, and every one of them was closed.
And I was going to say, nothing was happening. It was ordinary operations as usual. Yeah. Welcome aboard. Where's the water cooler? Right.
That's the journey.
Fantastic. So for our listeners, we have listeners here around the world. Many would know of Tanger, but tell us all about its scope, scale, and you've done some really new things as well with beyond the outlet store. So tell us all about it.
Well, like I said, it was at the time 40 shopping centers, 15 million square feet, and 3,000 retailers across, the United States. Primarily, we're in the Sunbelt states. So the company was founded in North Carolina. So, the original shopping centers that were built closer to home. And, the business, I'll go back 30 years when I was at New Plan Realty Trust leasing shopping centers in the outlet space. That business has really changed dramatically. At that time, it was really manufacturers whose sole source of meeting the customer was through their wholesale business. You're both department store people, so you understand that relationship. So the geography of outlets was so much different back then because you wanted to be at least far enough away from that department store business that the retailers, the manufacturers at the time had no problem, selling their own goods at a discount direct to the consumer.
And maybe we could talk about that because sometimes we just like to kind of chalk the field, so to speak, to give our listeners a sense of kind of the big picture. But if you had to just kind of help people understand the outlet store business today, and I know we'll get into a little bit more, you're not exclusively outlet stores anymore, but just kind of talk about that in the context of value retail, off-price retail, and how it's evolved. And then we'll kind of get into where it's going next.
Well, I think it's an important part of the story that, going back that history, because the manufacturers direct to consumer was really a big part of the business. In fact, the Tangers themselves were manufacturers. So if you go back, the business was founded almost 45 years ago. They had a company called Crate & Shirt. So Crate & Shirt was manufacturing in Greensboro, which was a big textile capital back in those days. Wrangler jeans and Lee and a number of other brands. Really, that was home base. Cone Mills was probably one of the bigger denim manufacturers in the United States at the time. So what they would do is they would run sales when they had excess inventory, when either a department store returned or they had some product that might have been factory seconds, an old expression that we don't hear much anymore. So they started holding friends and family sales, which were really the original outlet sales. They would sell at a deep discount, the goods that, just either hit the floor and came back, or just were never
hit the floor at all.
Never QC'd out of the warehouse itself. And I guess what they realized through that was they were selling more stuff out the back door than they were out the front door, and said, "Hey, maybe there's a business here." And they grabbed a bunch of their friends in the area, the Lees, the Wranglers, the Hanes, the Kohl, the Cones, and said, "Let's do something." And they took an old shopping center in Burlington, North Carolina. They converted it into what became the first outlet center. So that's really how the industry was born. Kind of interesting.
And I used to the term factory outlet used to be more, right? That's where that came from, right?
Yeah. In fact, it was, Tanger factory outlet.
Yeah.
And when I was at, in the early days, when I was leasing to brands, a lot of these brands had a factory outlet division. So, the evolution, what started was, and I'll go back to my Gap days because, fast forward for me, at least, 10 years of my career, and I'm at the Gap. What was interesting about Gap's retail strategy was, you would go into a market and, as a real estate rep working for the Gap, you were given a specific territory and they were like, okay, go out and grow the market share in your territory. So it wasn't like do 3 stores here and 2 stores there and 1 store. They basically gave you a growth goal and said go out and execute to the growth goal. So we were not only real estate deal makers, we were strategists. Our job was really to find what's the best combination of stores in order to land the plane on that market share and that growth goal. So one of the strategies that, it certainly wasn't invented by me, but one that I would execute to was for every 5 to 10 stores that you had full price, you would do a consolidation store. And that consolidation store was where all the goods that didn't sell in the full price stores. Now, rents were expensive back in those days, as they are today. And, you wanted to make sure that every square foot of real estate in the store really counted. So, and markdowns were a really important part of the strategy, as retailers, that, it drives a customer in.
Sure.
So you don't want to get rid of all your markdowns. You want to make sure that, you bring the newness is in the front and then your first markdown is in the back of the store. And that'll bring a customer. A customer will come in for newness and it's up to the store team to sell up and get them to buy the stuff that's not on sale.
Right.
But for the goods that just never cleared the floor and when excess inventory came in, they had to move it somewhere. And there was no secondary channel of distribution, we created this consolidation strategy. So if you had 5 stores in a New York City network, there'd be one of them, it was the Queens Center store at one point. It was the Austin Street store in Queens.
Sure. Yeah.
And that became the consolidation store, known for the place the consumer would go if they wanted to buy inexpensive Banana Republic or they wanted to buy an expensive Gap. Ken Pilot, who's actually, pretty important person here at Shop Talk.
We know Ken. Yeah.
So Ken was running Gap at the time, and running Gap Outlet was one of his divisions. And, he decided to get into the outlet business. And he was one of the first vertical retailers that made that decision. So as Gap got into the outlet business, they started to take stores and it was like, here we are in a purely manufacturing business with brands that we're only selling into the wholesale accounts. He had the idea, well, if the customer is coming and they're looking for value, then this consolidation strategy, let's use those stores for full price. They're on streets, they're in malls, they're in great locations. Let's consolidate our goods in the outlets. And that's pretty much how vertical retail found the outlet business. And that, you ask, is the evolution of outlet, that was one of the first major evolutions.
I've spent a little bit of time, a couple different times in the outlet business. It feels to me like the first part was very much driven by just, we have a bunch of inventory, we're trying to figure out the best way to maximize it. Then it was like, oh, this is interesting. There are customers, like enough customer demand for this price point, and these brands led to a more kind of customer-focused strategy, not excess inventory strategy. And then, and maybe this is the next part in your story, this was like, well, as these grew, suddenly we have more demand for product than we're actually able to satisfy through excess inventory. Is that the next place you'd go in the evolution, or is there something else? No,
I think that's really that's the journey, because Tanger is 40, and one of our biggest competitors in the space is 80, and I would say between the two of us, we probably have 75% of the outlet centers, at least in the United States. So if there's over 100 really solid outlet centers in the United States, 150, and you're a bigger brand that wants to be in all of those environments, and you don't want to disappoint a customer, so let's, bigger brands like a Ralph Lauren is a really good example, or Calvin Klein or Tommy Hilfiger, there'll be some excess, there'll be some manufacturing. So, in the case of Ralph Lauren, there are some product lines that make their way into outlet that you might not see in a department store today. But, a lot of that branding was born out of the outlet strategy of, it may not be the excess inventory, the finished product, but there may be a whole excess inventory of piece goods sitting in a warehouse somewhere that needs to be cut up. And so that cut up program that a lot of retailers use today, they take fabric that maybe, and fabric meets fashion. They take a great seller that may be, sold out in cashmere, but they cut it up in whatever, the wool jersey product that they have in the, and all of a sudden a new item might be born, but at the end of the day, it really achieves a couple of things for that retailer. One of which is, I'm getting rid of my excess piece good inventory. I'm cutting it up in a style that I know sold out, and now I can pass along a great style, great fabrication to a new consumer in a channel where we know that customer is looking for style and looking for fashion, looking for value.
So one thing, and maybe this isn't so true, but when I was at Neiman Marcus and we worked on our last call outlet strategy, we got to the point partially because we saw the opportunity to serve a customer that couldn't afford Neiman Marcus, basically, and it was about hitting a price point that was more attractive to them. Also, as internet grew, we got much better at clearing merchandise. So we started to say, well, when everything that used to be in the last call store had been previously sold, or we buy it from one of our vendors because it's an overstock, it started to be that the supply we needed to satisfy our last call strategy just meant we had to look at more made for outlet, and kind of the same thing you were describing with Ralph Lauren of different styles and these kinds of things. But it seems like that's been, sometimes I joke around like about Ralph Lauren because you've had your experience there, and you see all the stuff that's in TJ Maxx, you see all the stuff in the Ralph Lauren outlet stores. Like, well, they're either the worst inventory planning people in the history of the planet, that they consistently have so much inventory to serve more stores in the outlet world or the off-price world than they actually have full price, or there's a lot of product being made just for outlet. But I'm curious, like, to what your experience been and how that's evolved and how true that is today. And has it really just changed the way of thinking about outlet stores of not being outlets, but being kind of their own unique category of value retail? And it doesn't matter so much whether it's leftovers or whatever.
Well, look, I think we can throw a ton of brands into that same bucket. And I think that there's a lot of money to be made in that secondary distribution for sure. As a outlet retail person who's also very transactional, I grew up in leasing, and that's really where I've spent most of my career. As I'm the evolution of the outlet pitch has really evolved, right? Just the way I would come in and sell to you, the brand, space in my shopping center.
Right.
It was, hey, you need to clear excess inventory. This is a customer that really is just, that's what they want. They want branded.
They're a
value.
deal hunter.
They're
treasure hunter.
Deal hunting.
Treasure hunting.
And that storyline has evolved into, now I'm sitting down and I'm talking to you and I'm like, well, it's not just about turning your excess inventory into cash. Let's talk about meeting a customer, like you just mentioned, that Neiman Marcus, the last call or the Saks off Fifth,
right.
The customer that understands brand, understands fashion, but doesn't have, they're more aspirational.
Right.
And so for us, when we're pitching new brands to come into the business, that narrative is, here's a consumer that's hungry for value, loves brand, probably isn't going to shop you on Madison Avenue.
Right.
So here's a place
strong
for you
incrementality
to meet a new customer, meet them where they are, communicate with them, own them, and bring them up through your ecosystem. And that's a really important part. So when we see brands like Lululemon, I'll just use them as an example. There's a customer that the Lululemon price point, full price, is a little bit out of reach. But the brand is so important. People want to wear it. It's a great
Mm-hmm.
conspicuous brand to wear, and people are, even to go out and get coffee. It's not just for yoga anymore. And so that brand, when it came into the outlet space, became extremely important. But they only clear excess. They don't they don't manufacture for.
Right.
And what's interesting about that, it's hard to sign a 10-year deal when you don't know how much excess you're going to have.
Right. Yeah.
So that speaks.
And hopefully, you're trying to get better at having less of it.
You're working to have none.
Right. Well, exactly. Until you see, it's a great opportunity. Look, not everything's you can be the greatest retailer in the world. It's not planning. It's, sometimes you just miss.
Oh, sure. Yeah.
And so,
that's inherent. Yeah.
And their product lines, right? So last time I was in one, my wife and daughter saw a product line they'd never seen before that was clearly not a big success. So they're like, all right, we got a place to move that out. Like their Olympic stuff was like not a great success, and they moved it out. Let's not shift gears exactly, but let's talk about the consumer today. Sure. I mean, we've seen over the past number of years this flight to value. We might call it a stampede to value. We're going to see what that's going to look like. So you've got new players, obviously, in fast fashion, and you've also got your China factory direct model, which sometimes we refer to as a landfill direct model. You've got a lot of evolution happening. How are you guys responding to that evolving customer who's maybe they're shopping at Shein and Temu as well, and they've got this appetite and it's kind of ingraining into their behavior? How are you thinking about that now? And looks like that will continue with some economic distress.
Yeah, well, I think that we're all competing to get the customer off the phone, off the couch, and into your shopping center. And so the evolution of our business, at least post-COVID, has been the power shopping experience that once was outlet has evolved into more of a full service shopping experience, if you will. We realize that we have to be more things to more people. It used to be a car full of people would show up at the outlet center. They'd all go their different ways, and there'd be somebody who would find the most comfortable place to sit, buy a pretzel, and sit and wait for everybody to be done.
Yeah.
If I can find a way to keep that individual occupied in my shopping center, then maybe the folks will stay there a little bit longer. And how do I do that? Well, we've inserted better food and beverage.
Yeah.
So we're bringing a better experience to that shopper. It used to be you had to kind of leave the outlet center when they were 50 to 100 miles away, as dictated by the department stores back in the day. Yeah, sit-down restaurants could not sustain themselves on a weekend drive to traffic.
Sure.
Now that these centers have gotten a little bit closer in, or the population has moved out closer to the centers, which is post-COVID changing dynamics, people moving. We're finding that our customers looking, we got a customer who shops us as their core center more locally.
Right.
We need to bring more things in order to, to your point on, Temu or Amazon or however people are choosing to shop today. We got to be competitive with them. So we got to create an experience. We got to make it exciting.
Yeah.
And I use this analogy all the time, but I'm a long-suffering New York Jet football fan, and I have season tickets. I go to the games, and they're always sold out. Now, you can watch at home. It's a lot more comfortable. The bathrooms are cleaner. The parking is better. The food's going to be better.
Sure.
Right? And the TVs are 250
Bigger.
inches and, you got surround sound. You feel like you're at the game. Well, but people still want to go. They want that experience. But Stadium's done a really good job of upgrading the food, upgrading the VIP experience, making the parking easier, making the bathrooms cleaner, making the seats more comfortable. All the things that you get at home, they figured out how to get you off the couch and get you into the stadiums. And we're looking at that kind of inspiration in order to evolve our business, because I think we have a similar challenge.
Sure.
And we constantly have to create newness. Mickey Drexler used to say all the time, the only way you're going to get people in your store is if you're constantly flowing newness into the store. Well, we're the general merchandise managers of our shopping centers. And it's not just about picking the right retailers. It's about picking the right uses, the right experiences, the right amenities, the right entertainment uses.
Right.
And if we can put them all together in one place, that there's something for everybody to do, the narrative completely changes when they come for the food and stay for the shopping. When they come for the movie and they stay for the shopping.
Right. Sure. And one thing I was going to ask you about, because I think I think it's both the case that not only have you added some, I guess, more traditional shopping centers. I don't know how you would describe some of the additions, but I think it's also the case generally, I'm not sure how much for you, where we're actually starting to see, aside from what you mentioned about food and beverage and these kinds of options, but quote unquote regular stores sometimes being in the mix of what was traditionally an outlet center. Is that just more of responding to the customer and the geography you're in and the competitive environment, or is there something else going on there from a retailer perspective or from a landlord perspective?
Well, I think it's a mix of both. So if you take a look from the retailer perspective, there are retailers that want to put their product in front of this customer that's an aspirational customer, and they have perhaps they're a discounted price point. And, most of their stores are probably found in strip centers or maybe in some of the regional malls, but there's a customer that's coming, destination outlet, that they want to get their product in front of them. That part of the evolution, the post-COVID evolution that I was talking about, it talks about brands too, because there's categories that we don't necessarily hit at outlet. There's a Sephora and there's
I was going to ask about Sephora.
Well, these are brands that want to be in the outlet. They want to get in front of that customer. They're not necessarily discounting, they're not outlet priced.
It's the same format as you might find in a suburban lifestyle center, right?
Exactly. But, there's been, Old Navy is similar. H&M is similar. Victoria's Secret is similar. Bath and Body Works, similar. They'll do some consolidation. So every once in a while, you'll see some sales of products that you might not see on sale in other places, so that consolidation strategy is still alive and well and living in full price retail. But I think the major change for us is, as we've gone after those different types of brands, those different types of uses, the different amenities, we've learned that, we built a team to actually start, leasing that stuff, and we also have peripheral land that surrounds each one of our centers. Now, when you're 50 miles away from anybody, and there's no people other than those that are shopping on the weekends, as that evolution has occurred, we've now been monetizing our peripheral land.
Right.
So that's trained us to go after different uses and different types of businesses, sort of outside the four walls of the outlet center itself. Because of the confidence that we have in our ability to go after these uses, make deals with these tenants, that's what led us to go and buy the non-outlet shopping center, the lifestyle centers. And there's one other sort of key component that makes our journey into this business sort of unique, and that is, marketing. Marketing is critical. Department store shopping center marketing is critical, especially in the outlet space, because the retailers aren't using their marketing dollars to tell the customer, come shop us off price. They're using their marketing dollars to say, hey, come shop us on Madison Avenue. Come shop us at Bal Harbor Shops.
Right.
Come, but they're not saying, hey, go to the outlet. So they rely very heavily on us as the developer and owner of that shopping center to use marketing dollars that they contribute as part of their lease price for us to build that marketing muscle, go after the customer. And that's why you typically used to see, hey, Tanger outlets, 90 great stores, because we weren't allowed to tell the tale with regard to who the brands were. Now the brands are getting a little bit more flexible. They're letting us use their name on billboards and things like that. So now it's Nike, Ralph Lauren, Lululemon, and 90 great brands.
And 90 more great brands.
But that marketing muscle is so important. So as we get into the full price business, the lifestyle business, we've got that machine that a lot of our competitors in that space don't have. And, when you have 40 shopping centers to leverage that team over, now we have some scale.
Yeah, no kidding. Now, we're here, as we said, we're here at Shop Talk in Las Vegas. You were on the stage. I think you're talking about attracting a younger customer, maybe a loyalty-type program. Share what kind of knowledge you were dropping on the stage yesterday, I think it was.
Yeah, I had, the honor to speak with, a woman who's a partner at Bain who, opened the presentation with a piece on that Gen Z consumer and a lot of things. And she showed a video of a number of Gen Z consumers talking about what was important to them. And, it's so interesting, but, it wasn't that they were so loyal to a particular brand or so loyal to a particular way of shopping. Their loyalty was to value. Mm-hmm. Their loyalty was to great experience. Their loyalty was to, fashion, and they wanted to look good. That plays right into what we do every day. And so, I guess it was set up as if, this customer has grown up on their phone and grown up on the internet and has more ways of shopping than, any of us did when we were growing up.
Yeah, sure.
And, their patterns have changed. What are you doing about it? Mm-hmm. It was interesting to see, first of all, 3 of the 5 people that were spokespeople were wearing Ralph Lauren. I thought that was kind of interesting. And, so it was, it was fun. Somebody talked about fitness, and, I sort of made a little quip about, if you want to walk one of my centers, it's usually about 4,500 steps. So it's a good way to get your steps in.
I love how you know that.
I do. I mean, I count every day, all day. But, it's just, one of those fun things that you do. So I pretty much, not only do I know my center, my geography, how many stores I have in each center, what the sales performance is on a per square foot basis, what the occupancy is, who the next 3 retailers that we're going after to get in. I also know how many steps it takes to walk the entire thing. So it's just one of those things, it's like if you're going to own shopping centers, you have to really love what you do.
So from a landlord, maybe one last question before we let you go. And I've seen things that Simon has talked about and all this kind of stuff where because you're a landlord and you have these multiple brands, you don't necessarily have I'm not saying you don't, but that bringing things together as a landlord, responding to that digital customer. Now, I think you've got a rewards program. Is that one of the? I just want a little bit like, well, how are you using technology? How are you responding to the digital-driven customer as a landlord, as opposed to obviously the brands are often doing a lot of stuff individually?
Yeah, it's hard to set up a loyalty program unless you have a product to give away as a reward for their loyalty.
Right.
In the outlet business specifically, when you've got retailers that can daily flex their pricing model daily. And, if they've got an extra rounder of cashmere cable sweaters in the back and they want to move them because something else is coming in, they could, quickly go from, one piece for $300 to 2 for $5 kind of thing. Yeah. And so if you can change your pricing model that quickly in the outlets and not doing that in the full price business, if they give us the ability to help them move that product by giving us an additional discount, a stackable discount. The difference between a discount and a stackable. You walk in and you're like, well, you can use this one or you can use that one. Stackable means you can use them both together.
Yeah.
We can really reward our customers for their loyalty and coming in by giving them that additional discount funded by the retailers because, I just get a call from a retailer saying, hey, we need to drive traffic on Wednesday. What can you do to help us? Well, we've got a big database. We know which one of our customers shop which particular brand. So we can be very tailored. We can be very targeted. And from a digital point of view, we can really go after that group of people that we know are going to open the email or the text that we send them.
Right.
Because, if you're not a fan of Nike and I'm constantly bombarding you with Nike, you're going to stop opening my emails.
Sure.
But if you're a huge fan of Ralph Lauren and I only hit you with Ralph Lauren, then you're going to open them every time. Mm-hmm. So, it's like I want to train my customer to open my messaging. And, that's part of meeting them where they are. We're evolving from email to text because, the open rate of text obviously is way higher than the open mail. And email, things that we're learning along the journey.
Wow. Well, I'll tell you, this is a real masterclass in the evolution of retail more broadly and some really interesting dynamics. And it seems like, not that we should have to remind people of that, but, following the customer, paying attention to changes and responding to it quickly, turns out that often gets you great success. So we wish you great success going forward. And thanks so much for joining Michael and myself on the Remarkable Retail Podcast.
I'll leave you with this. The vision statement at Tanger is using customer insight to inform the future of shopping, which very simply stated is we ask a lot of questions and we listen to the answers and we execute, when we feel we need to execute to some of these interesting ideas that, everybody in our company as a customer, those are the people that you want to listen to.
It's a perfect way to leave it. Thanks so much, Stephen.
Thank you for having me.
Thanks for tuning in. New episodes of Season 10 are available each and every Tuesday, so be sure and tell all your friends in the retail industry all about us. And make sure and visit our newly refreshed YouTube channel for exclusive video and our new virtual store tours. If you liked our episode, please take a moment to give us a 5-star rating on Apple Podcasts.
And I'm Steve Dennis, strategic advisor, keynote speaker, and best-selling author of 2 books, Leaders Leap, Transforming Your Company at the Speed of Disruption, and Remarkable Retail, How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant and advisor, keynote speaker, and media entrepreneur. You can learn more about me on LinkedIn. Safe travels, everyone.